You're crazy. You're crazy, man. You're crazy. I like you. You're crazy.
So first we'll be covering banking and money creation. Banks create money by lending out deposits that are used multiple times, which effectively multiplies that money. These deposits come from depositors who give banks cash. And using this cash, banks determine potential loans using T accounts, which will be covered later on in this presentation. And just like any other financial body, banks have assets and liabilities, and this is how you make your T account. And assets of a bank include required reserves, which is the amount that the bank is required to hold of any deposit, excess reserves, which is the leftover of that deposit that can be lent out, property holdings, like any houses or buildings, and federal bonds and customer loans. And the liabilities include demand deposits, which is what's inputted by depositors, and owner's equity in stocks, because both of these things, the bank owes someone else something. One key concept in banking and money creation is that banks create profit by lending out excess reserves and collecting interest from the borrowers. And as money exchanges hands, some money is pulled by each hand as required reserves. So the original money in this way is multiplied. And a rough estimate of the amount of money that's created is found by doing excess reserves multiplied by the money multiplier. And the money multiplier, in turn, equals 1 divided by the required reserve ratio, which is a percentage of the demand deposit that the banks are required to reserve, and the rest of the deposit can be loaned out as excess reserves. So a conclusion that we can draw from what we've discussed so far is that demand deposits equal the required reserves plus excess reserves. And now let's move on to another topic within this subcategory, money supply. Money supply equals currencies in circulation plus checkable bank deposits. Money supply is not affected by citizen cash, but it is affected by excess reserves multiplied by the multiplier, because the currency in circulation expands, and it's also affected by the Fed buying bonds, because this creates new loans, which creates new money. And if the Fed buys the bonds on the open market, this money becomes demand deposits. And if it's bought from another bank, then the money becomes excess reserves. And another topic to cover within this subcategory is that bond prices are related inversely to interest rates. In other words, if interest rates rise, bond prices will fall, and if interest rates drop, bond prices will rise. And the best way to look at this is through an example. So let's say we have a bond that gives 5% interest, and then let's say the interest rates rise. So any new bond created will have an interest rate of, let's say, 7%. Then the seller of the bond is enticed to drop the price of the existing bond so that the interest that you gain essentially equals 7%, because you bought the bond for a cheaper price, so you're getting more returns. Now let's say in another example, you have the bond again that gives 5% interest rates, and then let's say interest rates drop. Then any new bonds created in this time will have, let's say, a 3% interest rate. Suddenly, the old bond with the 5% interest rate will seem very enticing to buyers, so buyers will flock to buy this bond. Thus, sellers are enticed to raise the price of this 5% bond so that the returns the customer receives drops essentially to 3%, because they're paying more for more returns. So the amount that they get back from their investment is closer and closer to 3%.
In the simplest terms I can think of, liabilities are what the bank owes to others, and assets are what the bank is owed, and what capital it has. But focusing in on liabilities first, these include, for example, people depositing their cash into the bank, the Fed Reserve buying bonds from the public, and even bank corporation stocks. The assets, meanwhile, are the excess reserves, or the money left after the reserve is deducted from the demand deposits, and this amount is used for potential loans to other people. The excess reserve was multiplied by the money multiplier, or 1 over the reserve ratio, to equal a new demand deposit. And overall, money is created out of thin air. As for various vocabulary terms, you have loans, which are the funds given from those excess reserves, bonds, which are what the bank purchased from the Fed Reserve, and finally, building and fixtures, which are bank property values. The bank's assets need to equal the liabilities on the off chance that there is a bank run, or when numerous people decide to go to the bank unexpectedly and withdraw much of their money. On the top of the slide are various formulas you might want to use, but I'll be focusing on the example. Say a person decided to deposit $100 into the bank. This amount of money goes into the liabilities because the bank owes that person $100. However, it has other people to loan money to. And so, instead of keeping those $100, it decides to only keep a percentage. This percentage is known as the reserve ratio, and in this case, it's 20%. And so, looking at the assets, the bank keeps 0.2 times 100, or $20 of those deposited 100. The excess reserve is the demand deposit minus these reserves. And so 100 minus 20 is equal to 80. By the effects of the money multiplier, or where the bank repeatedly saves a certain percentage and loans out the rest, multiply the excess reserve by 1 over the reserve ratio. This case, it's 80 times 5, which is equal to 400. And so out of thin air, by loaning to other people over and over again, $400 have been added to the money supply, making a total of $500. Now we'll look at the effects of changing the money supply on the interest rates and inflation. Changing the amount of money in supply obviously shifts the supply line, and we can see on the money market graph that the quantity of money is considered to be very inelastic. In fact, it's perfectly inelastic. And so, as you increase the amount of money in supply, the banks feel less of a need to have higher interest rates. After all, low interest rates are what drives the economy, because with low interest rates, more people get loans, and thus the real GDP is boosted. And so, as you increase the money supply, the nominal interest rate decreases. Meanwhile, money supply and inflation are linked because a high quantity of money usually devalues the demand for money. And if you look at the equation of MV equals PT, or money supply times money velocity equals price level, or inflation, times transactions, where velocity and transactions are considered to be constants, supply and inflation have a direct relationship. And because of this, as money supply affects inflation, it indirectly affects the real wage, because the higher the inflation is, the less the real wage would be in the short run. Also, moving on to the next one, higher interest rates offer lenders in an economy a higher return rate relative to other countries. And so a higher interest rate attracts foreign capital and causes the exchange rates to rise. And the opposite relationship exists for decreasing interest rates. So lower interest rates tend to decrease exchange rates. Now for the effect of changing interest rate on the bond price. This relationship is inverse. And the reason for this is that if the bond return rate is 5% and the interest rate is 10%, there's zero demand for the bond. And therefore, to entice more customers, the bond price is reduced. And so, as you increase the interest rate, bond price decreases, and vice versa.
What is the Federal Reserve? It's the central bank of the United States and is dubbed the Fed. It oversees and regulates the banking system and controls monetary base. It conducts monetary policy, which is the increase and decrease of the money supply, in order to speed up or slow down the overall economy. So how was the Federal Reserve created? Well, prior to 1913, American banking followed a system of national banks. Each was allowed to issue currency, but how much currency each issued was based on its capital. Yet this method remained to be inefficient. The nation still suffered numerous bank failures and major financial crises. The issue of the system was that the money supply was just unresponsive. It was difficult to shift currency around the country to respond to local economic changes. But during this time, trusts, which were bank-like institutions that accepted deposits but were intended to manage inheritances and estates only, began to speculate in real estate and stocks. After this, trusts were able to pay depositors more money, which led to their increase in consumer reliance and exponential growth. But the panic of 1907 started with the Knickerbocker Trust failure and stock market speculation, leading it to suffer massive losses. An increase in widespread distrust in these trusts, and depositors began withdrawing their money. Credit markets froze, stock markets fell, and the business confidence evaporated. But J.P. Morgan came into rescue when he worked with other bankers to decrease the panic. The panic prompted the federal government to initiate the Federal Reserve System in 1913, which was created to compel all deposit-taking institutions to hold reserves and to open accounts for inspection by regulators.
The Federal Reserve. Structure. The structure of the Federal Reserve slightly differs from the other banks. It has the power to directly regulate the banking systems, while still possessing the traits of a normal bank. The Fed consists of two main components, the Board of Governors and the 12 regional Federal Reserve banks. The Board of Governors. Similar to any other board organizations, the Board of Governors was created to oversee the actions of specific institutions, in this case, the Fed. The board consists of 7 members at all times. Each member has to be appointed by the President and accepted by the Senate. The members serve 14 years before the term expires. The chair of the Fed serves only 4 years, but he or she will usually serve multiple terms. For example, William McChesney Martin served as chair from 1951 to 1970. The 12 Federal Reserve Banks. These banks are located in the Federal Reserve districts all around the U.S. in different regions. The Fed banks influence the financial world by supervising and maintaining all the surrounding banks' input and output. Each of these federal banks has its own board of directors and president, chosen by the local business community. The Federal Open Market Committee. The Open Market Committee is where decisions regarding monetary policies are made. The FOMC's president is usually the chair of the Federal Reserve, and its members consist of the Board of Governors and 5 of the 12 regional bank presidents. Each of the presidents serve 1-year terms before rotating, the exception being the president of the New York Federal Reserve Bank, who is a permanent position.
A T account or credit debit balance sheet is a table that is used to organize all the information covered previously. Assets appear on the left while liabilities are on the right. Especially for banks, both sides should be equal to show the institution's solvency. Let's suppose that a person deposits $100 into their bank account. The bank is required by the Fed to save, in this case, 20% of that money, but they can deposit 80% of it in their excess reserves. This gives them the ability to loan out $80. To give a rough estimate of how this money will be multiplied as it moves through different institutions, we can multiply the excess reserves by the money multiplier, or 1 divided by the required reserves rate. The initial demand deposits added to this estimate shows the maximum total change in demand deposits in the banking system. But what happens when a person wants to take out some money? If they ask for $20, there's no problem. But any more than that, the bank must borrow from either one another through the federal funds rate or through the Federal Reserve.